Thank you for watching this Money Matters presentation, Reaping Your Rewards. This presentation will teach you about credit cards, credit card rewards, the good, the bad, credit scores, credit reporting, and most importantly, how to reap the most of your rewards. My name is Rachel Mason, and I'm one of CVTC Student Central Advisors. Between my esteemed colleague Katie Beck and myself, we are here to assist you before, during, and after your time at CVTC. Our roles are to help students who are undecided about programs or may need help interpreting or taking a career assessment. We are also highly trained in all things financial aid and financial coaching. During financial coaching appointments, we can address and help you with various financial wellness topics, including debt management, budgeting, credit scores, and more. You may hear us talk about moolah. While we can't give you actual moolah, what we can do is reward you for participating in Money Matters events. Each Money Matters activity, such as workshops, classroom takeovers, events, seminars, online activities, and one-on-one advising and coaching appointments, are assigned a moolah amount. Moolah is a raffle ticket. The more moolah you earn, the better chance you have of winning prizes. Every semester, Money Matters puts on workshops for various financial wellness topics. Each month is a new topic, and by attending a workshop, and recordings like this work too, you will earn $10 in moolah, plus be entered to win one of the workshop prizes. If you have at least $15 in moolah, you are eligible for the semester grand prizes as well. The more moolah you have, the better chance you have of winning. And while these might not be the workshop and semester prizes for the semester you are attending or watching, you can check out all up-to-date workshops, the times, and prizes by checking out the Money Matters page in your My CVTC. And today, you can earn $10 in moolah by watching this classroom takeover presentation and completing the survey that was attached. If you have other questions, you can email us. Our email is just as it sounds, Money Matters, all one word, all lowercase, at cvtc.edu. You are now only $5 away from being entered to win one of the grand prizes that vary from semester to semester. And these are a few, and I'm going to emphasize a few of our past Money Matters winners. For over 6 years, we have had thousands of students win prizes for attending various Money Matters events. In the past, winners have won Roombas, grills, outdoor patio sets, country jam tickets, hundreds of dollars in gift cards, and espresso machines. We hope your picture is on our next one. Let's dive right into this presentation. First things first, what is a credit card? A credit card allows card holders, people like you and me, to borrow funds from an institution like a bank or lending company to pay for goods and services with stores or at stores that accept credit cards as payment. It imposes the condition that card holders may pay back the borrowed money. Since you are borrowing money, it is not free. So you are also agreeing to pay back the lender any applicable interest or any additional agreed upon charges by the billing due date. Credit cards sound great, right? Now you may be wondering, how do I get one of these? While it is pretty easy to sign up for a credit card, you need to understand what you are committing to. First, check your credit score. Choose the type of credit card you want. You'll want to compare credit card offers, really read the fine print, apply for one credit card at a time, and then wait. Sounds simple. Well, let's learn the reasoning behind everything. So why does your credit history and your credit score matter when applying for a credit card? Credit card issuers will likely use them and other factors to evaluate your credit worthiness and decide whether to approve you for an application. What does it mean to be creditworthy? Well, we always tell students that credit scores and credit do not define you as a person or make you a good or bad person. It is good to know what it means and understand how it may affect your financial goals moving forward. Credit worthiness refers to how likely a potential borrower is to pay back a line of credit. It is the baseline for lenders when deciding to loan an application and money for things like buying a car, taking out a mortgage, or opening a credit card. Lenders may consider different factors when measuring an applicant's creditworthiness, including the 5 C's of credit, which we'll talk more about soon. It's important to note that the creditworthiness can be improved by taking steps to improve credit reports and your credit scores. And you may have heard of a credit score, but what is it really? Credit scores are essentially snapshots of a person's credit history, which can affect everything from lending decisions, loan terms, insurance premiums, and even rental applications. There are 5 factors that determine your credit score. The largest, which is about 35%, is your payment history. So making debt payments on time every month benefits your credit score more than any other single factor. Just one payment made 30 days late can significantly harm your score. Having an account sent to collections, a home foreclosure, and bankruptcy can have longer lasting consequences. Making up 30% of your credit score is the amount owed. The total amount you have borrowed affects your credit score along with your available credit tied up in outstanding balances. The percentage of your total borrowing limit you are using on your credit card is a significant factor in determining credit scores. It's the most responsive to your actions. Paying off a high balance credit card for 1 month will boost your credit score more once the payment is reported and then that new score is calculated. While it may not make the most sense, your length of credit history does play a huge factor in your credit score. 15% of your credit score is determined by your experience with credit accounts. The longer your credit history, the higher your credit score will be. Your credit score measures your older credit account, the age of your newest credit account, and the average age of all your accounts. According to Experian, closing accounts and paying off loans is good for your payment history, but it doesn't immediately cancel out their ages for purposes of calculating the length of credit history. The accounts you choose to close in good standing, meaning with no late payments, remains on your credit report for as long as 10 years. The ability to manage multiple debts and a variety of credit types can benefit your credit score. Credit scoring calculations favor a mixture of installment debt, such as student loans, mortgages, car loans, and personal loans, and then the revolving accounts, such as credit cards and lines of credit. The credit mix makes up 10% of your credit score. Finally, coming in with 10% of your credit score factor is new credit applications. This category includes the number of recently opened credit accounts and all new credit inquiries. Inquiries are made by lenders looking at your credit report before approving or denying your request. Inquiries will remain on your credit report for 2 years. This shows potential borrowers that you are either price comparing, finding the best rate, or it shows that you are trying to apply for any type of credit or credit card, which is why they typically take all 5 C's and your overall score into consideration. Now let's talk about these 5 C's you've been hearing about. The 5 C's of credit is a widely popular framework that considers 5 characteristics of the borrower to help lenders determine the creditworthiness of the borrower. The first C is character, or sometimes called credit history. This refers to a borrower's reputation or track record for repaying debt. The second C is capacity. This measures the borrower's ability to repay a loan by comparing income against recurring debts and assessing the borrower's debt-to-income ratio, or DTI. The third C is capital. So down payments indicate the borrower's level of seriousness, which can make lenders more comfortable extending credit. Essentially, they want to know what is your leg in the game. The fourth C is collateral. Any personal asset that the borrower pledges in order to support the loan acts as a lender's backup in case you are generally unable to repay your loan. Do you have savings or assets like your home, car, or business that can be claimed if you don't make your payments? And the final C is conditions. The conditions of the loan, such as interest rate and the amount of principal. This influences the lender's decision to finance the borrower. Conditions can refer to how a borrower plans to use the money. Each lender has their own method for analyzing a borrower's creditworthiness. They may use a combination of looking at the borrower's credit scores, credit reports, income statements, documents relevant to the borrower's financial situation, and the 5 C's. Getting your first line of credit can sometimes be challenging. If you don't have a credit history, or if you have filed bankruptcy in the past, credit lenders may be reluctant to extend you credit. Start small and build your way up. So it's important to establish a relationship with your financial institution. While you may think that you don't matter to banks and you are just a number, that is not always the case. And having a relationship can benefit you. And I want to share my story about that. So I'm originally from southern Minnesota, and I opened a bank account with a local bank there when I was about 10 or 11. I've only banked there, even when I went to college in Wisconsin, when I've worked in Wisconsin, and now have lived in Wisconsin for over 9 years. Since everything is online for banking, it has not affected me in any way. But now that I'm 32 and want to buy a home, I was worried about getting a mortgage in Wisconsin and having to move everything to a bank here. Instead of moving everything, I talked to my bank in Minnesota and asked them about multi-state loans and mortgage rates. They mentioned to me that they have a branch right over the Minnesota border in Wisconsin, so they could legally offer me a mortgage loan in Wisconsin. Since I have over 20 years of history and a relationship with them, they know my credit history, my borrowing trends, and they were able to offer me a much lower interest rate for homes than the national average. So in this instance, it paid to have that relationship, as it can save me tens and tens of thousands of dollars, but also for you as well. If you regularly pay your rent on time and in full, you can have your good history reported to credit bureaus to help establish and raise your credit score. However, your rental payments will not make your credit report or reports unless you and your landlord are enrolled in a rent reporting servicer. Reporting your rent payments to a credit bureau is fairly simple. You can either have your landlord manually report your rent for you, or you can do it yourself using a rent reporting platform like Credit Boost. Most renters prefer to report their rent payments to a credit bureau themselves since they have more control over the process. Your landlord will need to set up an account in order for you to take advantage of this tool. This is another good example of why establishing relationships is important. Without credit history, it may be difficult to get an unsecured credit card, but don't give up hope just yet. There's another option called a secured credit card. A secured credit card is a type of credit card that requires a security deposit or down payment to open the account. The card holder, like you, typically makes a one-time refundable deposit that acts as collateral for the credit card issuer. Now that you've built your credit, it's important to maintain your credit. No strategy to improve your credit will be effective if you pay late. Worse, late payments can stay on your credit report for 7.5 years. Another reason to establish a relationship with your creditor is for late fees. If you miss a payment by 30 days and it's your first time making a late payment, or you've done it very seldomly in years, they may be more willing to either remove the late fee, or sometimes they may no longer report it to the credit bureau as a missed payment. You can build credit by staying below your credit limit. A credit limit is the maximum amount of credit a financial institution extends to a client on a credit card or line of credit. Many credit experts say you should keep your credit utilization ratio, the percentage of your total credit that you use, below 30% of your total available credit to maintain a good or excellent credit score. If you have a credit score or a credit card with a zero balance that you aren't using very often, you might think it's a good idea to close it. But keep in mind that a credit card with no balance has a credit utilization of 0%. Closing it would decrease your available credit and increase your credit utilization, which could and can negatively impact your credit score. Be careful with credit applications. Applying for a bunch of credit at once isn't likely to help you build credit any faster. In fact, it could make your financial situation look worse than it is. To avoid unnecessary credit inquiries, consider using a service like CardMatch to get pre-qualified credit card offers and only apply for cards that are likely to be a good fit. Once you get approved for a new credit card, wait at least 3 months before applying for the next one. A recent Consumer Report study revealed a third of Americans found errors in their credit reports, and many of those errors have or are having the potential to damage your credit score. It's important to monitor your credit report and dispute credit report errors. Once you file a credit report dispute, it can or could take around 30 days for the credit bureau to investigate and respond to your dispute, and another 30 days to remove inaccurate information from your credit report. Your credit report acts as your financial reference when applying for any type of credit. The only way to maintain good credit or good history is to use credit wisely. There are 10 tried and true tips for building credit. So create a spending plan and live within it. Credit should not be used beyond your means, no matter how tempting it may seem. Provide complete, accurate, and consistent identification on your credit applications. This information helps set up your credit history correctly from the beginning, and it ensures that your new accounts will be matched to the correct report, and it minimizes the chance that your credit file will be incomplete. Pay your bills on time, all the time. Late payments, called delinquencies, negatively affect your ability to get credit since they indicate a stronger likelihood that you will make late payments again, or you'll be unable to pay your debts in the future. Have some credit, but not too much. Having no credit history is almost as bad as having a negative credit history. You only need a few accounts reported to the credit reporting companies to demonstrate credit management. Having a mixture of credit types is good because it gives you a history of your repayment on an installment loan, but revolving accounts demonstrates more clearly that you can responsibly manage credit. You want to keep your credit card balances low. Keeping your balances low compared with credit limits shows that you aren't tempted to charge more than you can pay. Charging a small amount on at least one card and paying the balance on time will show that you can handle large amounts of available credit. Use caution when closing an account or accounts. Closing an account isn't always a good thing. As mentioned earlier, it can result in an increase to your balance to limit ratio, making you appear to be an increased credit risk. Be aware of your debt to income ratio. Mortgage lenders consider your monthly payments compared to your monthly income. Demonstrate stability. Some creditors consider your length of employment, your length of residence, whether you rent or own, and if you have any savings in making those credit decisions. And finally, contact your lenders if you fall behind on your payments. Many lenders will work with you to set up a different payment schedule or interest rate. We mentioned how your credit is established and how your score is reported, but do you know where to check it? So a credit reporting agency, or a CRA, is a company that collects information about where you live and work, how you pay your bills, whether you've been sued, arrested, or filed for bankruptcy. All of this information is combined together in a credit report. A CRA will then sell your credit report to creditors, employers, insurance, and others. These companies will use these reports to make a decision about extending credit, maybe a job, and insurance policies to you. Typically, without this pandemic in the last 3 years, you are entitled to order every 12 months, so every year, a free copy of your credit report from each of the major credit reporting agencies. And those are Equifax, Experian, and TransUnion through annualcreditreport.com. This website is the only one that the government is authorized to provide you with free copies of your credit report. So consider staggering requests throughout the year. For example, order a free report from Experian in January, order a free report from Equifax in May, and order a free report from TransUnion in September. The next year, start over with a free report from Experian. Within the last 3 years, you've been able to go on weekly to these credit reporting agencies and the creditreport.com and get your credit score and credit report. So please utilize that while you can, but in the future know that it's once every 12 months and you'll want to stagger those requests. And you can also contact the credit agencies directly if you need to dispute information in your report, place a fraud alert or security freeze on your credit file, or if you have other questions. Now that we have gone over basic credit, credit scores, and credit report information, ask yourself these 2 questions. Who would you extend credit to, and would you extend credit to yourself? So you should choose the type of credit card you want. Ask yourself, what are my biggest needs? What will I use it for? What is my current financial situation? And do I understand the minimum payments and interest rates of the card? In general, if you plan to use your credit primarily for credit building, you'll want a card with low fees to help keep costs down until you can qualify for more attractive terms. Now, on the other hand, if you're a big spender and want to get the most value possible out of your card, you'll want to get a rewards card that gives a good overall earning rate or emphasizes your most common spending categories. In addition, people who plan to carry a balance on their credit card will want to focus on getting a card with a low annual percentage rate, while those who will pay in full each month don't need to worry about that as much because they're paying in full and won't accrue that annual percentage rate. Some cards are designed specifically for financing big purchases and balance transfers, offering 0% of the introductory APRs. There are different types of credit cards, especially for those at different stages in their financial journey. This slide shows what credit cards to get, or at least learn more about given the situation you may be in. So if you're new to credit, you don't have any credit, your credit score is 0 or undefined, it's good to start with a starter credit card if you're trying to rebuild bad credit, or if you also are starting, it's good to get that secured credit card. If you are a student and you could fall into situation 1, 2, and 3, you could qualify for our student credit card as well. If you're making everyday purchases, get a rewards credit card. If you're already in credit card debt, work with your lender or creditors to get a balance transfer credit card or that secured credit card as well. If you're going to carry a balance, get a 0% introduction rate credit card. And then if you're a business owner, get a business rewards card for everyday spending. It's important to compare credit card offers. Comparison shopping is the best way to find the best deal. After all, you'll have no idea how a given credit card compares to other available offers if that's the only one you consider. So you'll want to consider eligibility. Different cards require different credit scores. In addition, some cards are targeted to specific types of people like students or business owners. Comparing membership fees, the cost of the card should not outweigh the value you get out of it. The APR, and we'll talk about it in the next slide or two, is the card. So a card's interest rate only matters if you plan to carry a balance from month to month. Some cards also have an introductory APR, often 0% on purchases, balance transfers, or both for certain numbers of months. This is an attractive feature if you plan to finance big purchases or make a balance transfer. Compare on rewards. Credit card rewards can save you a lot of money on purchases over time. There are three main types of rewards: cashback, points, and miles. Cashback cards tend to be geared more towards those everyday purchases, while cards with points and miles more often focus on travel. There are plenty of exceptions though. There are also store cards and co-branded cards that offer rewards at partnered merchants and more. And finally, compare the benefits. Many cards offer supplemental benefits like rental car insurance, travel insurance, purchase protection, and extended warranties on purchases. Higher end cards may even give luxury perks like annual credit or credits on certain types of purchases or airport lounge access. It's a good idea to double check a credit card's terms and conditions as well as its benefits guide prior to applying. This way you won't have any surprises later. All credit cards will require you to be at least 18 years old with enough income or assets to afford a card's monthly minimum payments, a valid identity, and a U.S. mailing address. Most cards do require you to have a social security number, though some will accept an individual taxpayer identification number or passport as a substitute. Other requirements, like those pertaining to your credit score, vary from card to card. Aside from a card's requirement, you'll want to know all of its fees and interest rates. For example, it's important to know if a card has an annual fee or charges extra for international transactions. Even if you don't plan to ever carry a balance, you should know what you'll be charged if you do. If the card is a rewards card, you should always know when the rewards apply. For example, does the card offer different rates and different spending categories? Is there a yearly or quarterly spending cap for bonus rewards? And if there is an initial bonus, what is the spending requirement to earn it? You should always or also be familiar with whatever your card's rewards expire. In general, it's best to redeem your rewards often. It's a good rule to apply for one card at a time. Casting a wide net by submitting numerous applications at once won't ensure that you catch at least one credit card. Rather, it can or will hurt both your credit and your chances of approval. So if you don't get approved the first time around, set your sights a bit lower and even consider placing a deposit on a secured card. So to apply for a credit card, you have to get pre-approved or pre-qualified first. You'll want to check your latest credit score, fill out a credit card application. Applying online is the fastest for that. Submit your application and wait for a decision, and then get your card in the mail. Credit card applications require you to provide personal information, including your name, address, phone number, and social security number. They also require financial info such as your income, employment status, and housing status. You can learn more about how to apply for a credit card at wallethub.com. It generally takes 7 to 10 business days to get a new credit card after being approved for an account, and many people receive a decision almost immediately after applying. Once you open your credit card account, the real work begins. Making purchases with a credit card is easy. We all know that. But paying your bills on time and keeping your credit utilization low, for example, can be harder to pull off. Both are critical to credit improvement, though, so you'll need to learn fast. Now that you know how to go about getting a credit card in general, let's look closer at how these things work when you have no credit or bad credit. There are some unique factors to take into account in those situations. Financial institutions must disclose a financial institution's APR before any agreement is signed. Annual percentage rate, or APR, refers to the yearly interest you'll pay if you carry a balance on your credit card. Some credit cards have variable APRs, meaning your rate can go up and down over time. Check to see if your credit card's APR is tied to a promotional or introductory rate. Your APR could go up after the introductory period. The APR provides a consistent basis for presenting annual interest rate information in order to protect consumers from misleading advertisement. An APR may not reflect the actual cost of borrowing because lenders have a fair amount of leeway in calculating it, excluding certain fees. APRs should not be confused with APYs, the annual percentage yield, which is a calculation that takes the compounding of interest into account. You just have to make minimum monthly payments to keep your 0% intro APR, and you should pay off most, if not all, of what you owe before your credit's high regular APR takes into effect. 0% APR sounds great, right? So in most cases, regular interest rates will apply to whatever balance remains at the end of the 0% intro period. But when stores offer 0% financing, it often includes something called deferred interest. That means if you fail to pay your full balance by the end of the 0% term, regular rates will retroactively apply to your original purchase amount. Avoid deferred interest payment plans at all costs. Now, while you're all here, it's time for the fun things regarding credit cards, the rewards and perks. Reward cards are credit cards that offer some type of rewards, such as cash back, points, travel miles, etc. You earn a designated dollar amount that you can spend up to a certain limit towards getting those rewards back to you. Reward cards present a large portion of the credit card market today. The video on the next slide does a great job of explaining how credit card points and rewards work. Let's check it out. So credit rewards can be very confusing, and we found a great video on YouTube that breaks down how credit cards points and reward system works. When we present this in person, we can easily just hit play on the image and YouTube will pop up. But unfortunately, we aren't able to do that on the recording. So on the next screen is going to be a QR code. We'll leave that there for a little bit. So if you want to take a screenshot of it or do it right now and then finish the rest of this recording later, we just didn't want you to not be able to view the video because it is really important and it does a great explanation of it. So as mentioned, here is that QR code that will bring you directly to that YouTube video of credit card reward system and points. Please pause this if you want to save it for later, come back, go to it right now, then finish the recording. Anything that makes sense for you, or if you don't want to watch, you do not have to, but it is just, again, another great resource that we wanted you to have. Just like any credit card or purchase, it's important to compare and find. Compare the annual percentage rate, the annual interest rate, annual fees. Ask, are there tiered versus fixed rewards? And are there cashback spending caps? Find the best card that works for you by analyzing your spending habits and checking your credit score. Now in our role, we always say, find what works best for you. So like budgeting methods, saving plans, and even credit cards, finding what works best for you and would benefit you the most is what you need to do. However, don't forget about that fun, and I'm in quotation marks, fun information we talked about earlier when making these decisions. While we won't go over every credit card on this list, we found from credit card experts that these cards have the best credit rewards for particular uses. So if you are a traveler or want to travel more, the experts say Chase Sapphire's Reserve would be the best option for you. When you are a student and you want to build credit or maintain credit, the best student credit card is through Bank of America Travel Rewards for Students. And if you like to shop online, within reason, of course, Capital One Savers One Cash Rewards credit card, that's a mouthful, may be the best for you. So take a picture of this screen and you can do more research to find what works best for you. You may have heard of rewards cards, but what are store credit cards then? You know, that dreaded question almost every retail employee asks you when you are checking out. That is what rewards cards are. Also, did you know that 6 out of 10 US adults have applied for a retail credit card and about 2/3 of them have done so impulsively? While it may seem great to get 10% off your total purchase now, but as we talked about in great length today, credit cards do have their drawbacks, and so do store cards. Store credit cards or store cards and credit cards that have a limited use compared to regular credit cards and can typically be used for purchases from a specific store or group of stores. There are two types of store credit cards. One's a closed loop card, and that can only be used at that particular store or chain of store branded credit cards. There's open loop cards, can be used anywhere where the card network, such as a Visa or MasterCard, is accepted. Typically, this has the retail logo on it, but it can be used more widely. Like everything, there are pros and cons to store credit cards. Store cards, while very similar to credit cards in their work, store cards often have a cash back reward system. It offers credit to offset your statement balance or funds that can be applied to future transactions. Unlike a credit card, store cards typically are easier to apply for as they don't necessarily look at debt to income ratio and can be approved right on the spot. They can also also help and build and establish credit if you don't have any or your score may be lacking. However, it's important to know that store credit cards build interest like credit cards, and it can be easy to rack up credit card debt, especially if it's your favorite store. Store cards, on the other hand, are less versatile and have lower limits. Store credit cards tend to have lower credit lines, so using them could raise your credit utilization ratio, which could, in turn, lower your credit score. They have higher interest rates. Per the Federal Reserve, the average annual percentage rate, or APR, for a store credit card is 24.97%, so about 25%, while the average American, based on their credit score and factors, pay about 17% on other credit cards or credit card debt. As mentioned earlier, a positive payment history with a credit score or credit card can help your credit score. It is less impactful than a positive payment history with a major credit card. Rewards from a store credit card are earned on purchases only from the retailer or the chain and have limited redemption options. Major credit cards typically provide rewards on a wide array of eligible purchases from many different merchants and can be redeemed in a variety of ways. And this isn't anyone we know, it's just something that we found in one of the websites, and it just really shows how, in this example, David has 3 different credit cards, what his debt is on the credit card, the interest rate, and then what he's paying monthly in the interest rate. So it can add up really fast, and it's easy to want to go in and just grab what you can, whether it's store cards or typical traditional credit cards. We just wanted to share this to get an idea visually, especially if you're a visual person, to show how it is easy to rack up credit card debt. we give out a lot of information because there's so much that goes into credit cards, credit scores, maintaining good credit, reward cards. So if you have any further questions, please reach out to us. You can call the main Student Central line, which is 715-833-6200, or the best would be Money Matters. It's one word, all lowercase, so Money Matters at cvtc.edu. Email us and we can schedule an appointment or come up with any follow-up questions. And then it does not have to be anything related to credit cards or credit rewards, but you can schedule a one-on-one appointment with one of the Student Central advisors. So besides learning information that you maybe wanted to come with or that we provide, you'll also earn $10 in moolah. Remember moolah from way earlier for those prizes and workshop swag that we mentioned earlier. So thank you so much for watching this presentation about reaping your rewards and when it comes to credit cards and credit scores. And we want to know how we did. Please, if you have a chance to take a picture of this QR code, or if you have questions, email us and we can send you a direct link. You giving us feedback helps us prepare to present better, change up feedback. Maybe there's things that you really wanted to learn more about that we didn't offer. We can do a Reaping Your Rewards workshop part 2. Anything you can give us really helps us, but it also helps you because we can be the best for you. Also, if you do this QR code survey, we'll also give you extra moolah for participating, which can be used for those grand prizes. So again, thank you, and you have a great rest of your day.